Bloomberg Audio Studios.
Podcasts, radio, news.
The week. To make sense of these markets, with us now is Paul Reilly. He is the CEO of Raymond James. Paul is the third CEO in the firm's history and will be passing the reins here to Paul Shoukry while remaining on board as executive chair. And we're going to talk about succession, the future of Raymond James, but we also want to get your thoughts on how clients are reacting to the market environment and some of the big ticket items that are happening here in the world of politics. It is incredible. We have just reported a story on just how much it would cost here to see the Trump tax cuts be maintained, to see just how much it would cost at the end of the day. And according to certain experts that we're citing here, it would cost more than almost all federal agencies. The tax cuts expire at the end of next year. Either president would have to really grapple with this issue. What, in your view, would be the most damaging to investors? What is your staff talking about as they talk to clients?
Well, it probably depends where you fall, in the snack brackets here. So probably the wealthiest investors, the proposed, not just the expiration, which doesn't affect them that much, but some of the proposed tax increases on net worth, unrealized gains and stuff really has them concerned. And so I know people are worried about it, but it's way too early to call the election. It's way too early to know what would even pass, whether House or Senate will be divided or not, and what does it take to pass the tax changes. So there's a lot of speculation, but not much to realize, what's really going to go on yet.
Yeah, it's interesting because you see the two campaigns taking two different strategies. Yes, that unrealized taxes on capital gains here are something that many investors are concerned about. But then you have Kamala Harris floating that idea about really reducing kind of the tax burden on small businesses. At the end of the day, would you like to see large corporations tax more, small businesses tax less? Where does kind of that tax burden have to come from in corporate America?
Yeah, that's kind of a hard one because no matter who you pick, someone's not going to be happy in that. So, corporate taxes, I think in general, individual income taxes aren't at an excessive rate. So the question is, can they really go down? Well, you got to fund the deficit, which will continue to increase. So the question is more where you're going to apply some of those savings. And investors worry about different things. Certainly the estate tax exemption going down, that's a near-term thing when people trying to, want to use that up. So when will they get an indication? The highest rate, going down last time, I personally think that wasn't needed, but there are probably a lot of people that would disagree with me. So again, it's a matter of how do you raise the money and who pays. So.
I mean, it's just not an obvious thing.
Right.
I think personally a lot about the state and local tax deduction, right, which was capped. Trump capped that before the election. I could write off my property taxes from my federal. Now I can't. And if I had that extra money, I would spend it straight back into the economy, every last cent. So, yes, it would cost more, according to this accounting, in the future, but it might also boost GDP if people like me put it right back into the economy, right?
Well, my question is, Raymond James has an extensive network of financial advisors. Does that dominate conversations with financial advisors right now? Basically, those tax questions that Matt is sitting on here?
I think people are more focused on what's going to happen in the near-term economy. Their clients. They're talking about what the tax implications can be, but I think, again, it's too early to really focus on it too much. So they're having conversations over cocktails or in a conversation like we're having today. Mm-hmm. But I think they're more worried about where's the economy going, what's going to happen, will rates go down, and those types of things are more dominating the conversation right now with advisors and their clients.
Yeah, unfortunately, no cocktails on this set. It's a little early, but shifting a bit away from politics here, when it comes to that financial advisor network, you said recently you have about 8,800 financial advisors as of June 30th. That's up 1% from a year ago. And I'm always curious about the role of financial advisors. Obviously, younger investors are entering the market, millennials, Gen Z. Is the role of the financial advisor shifting? How do they remain relevant?
Well, for the last decade, there has been a big shift. A lot of advisors, what I call asset allocators, where should I put my investment dollars? But that's really shifted into being wealth planners. Advisors that are successful are integrated so much into the family, people don't realize. They're helping families make family decisions, allocations, setting plans, and helping people achieve where they want to be, not just performance. It's what are my goals? Am I in a good position to hit my goals? So they've really become integrated into the family. And what everyone said, well, X and Z, they're going to pick their own. We're not seeing that. I take my own 6 kids from 27 to 40. I remember my 40-year-old said, why would I ever invest $1 in the stock market? It hadn't gone up. Well, she's invested. My kids are invested. They have advisors. Some have their own advisors away from me. But they're all using financial advisors, even though they were the people that were going to make their own decisions. It's too complex. And retail individuals need that push to do things. It's like writing the first will. People are afraid to sign a will because they think they're signing their death certificate or something. People are going to die eventually. It's the financial planning. But just to get people to sign it's hard. To get people to stay in the market when it's off is hard, right? And that's their role.
It's hugely important. And by the way, good for you for tripling the replacement rate with 6 children because demographics are going the other way, right? I mean, we talked to Sally Krawcheck on this program, and she was talking about the fact that, the boomers have like $75 trillion. I think Yardeni gave me that figure, but $75 trillion in wealth that they're going to eventually pass on. You have now, I think, $1.5 trillion under management at Ray J. Is that going to keep growing as they pass it on? Are they spending it? I mean, where do you see that going?
Yeah, I think that certainly when you divide wealth into pieces, probably everyone spends, you get a little more spent, just because they have more and it gets divided up. So, but I think it'll continue growing. I mean, do you believe the markets will grow over time? And I believe they will. It doesn't mean we've been waiting for this adjustment, right? We've had a 15-year run. When's the last time we've had a really 15-year run in the equity markets? But people have been talking about the soft landing for 3 years, right? Now we're onto the next year. There'll be a correction at some point, but I believe long-term the markets will continue to grow, so those invested their wealth should continue to grow. And if our advisors are doing their job on succession, making sure their kids are involved, bringing next-gen advisors on their teams, which all the good teams do, I think, we'll continue to keep our share of the wealth and have the business grow.
Paul, it's been really interesting. If you look at Raymond James' stock over the last 20 years, for example, you've only had 3 down years, and that includes 2008. So quite the run here. If you look at the next 20 years of Raymond James' growth, where does it come from? Do you see an opportunity to buy assets, to increase in wealth management, an M&A capacity? Where are the biggest growth areas for you?
Well, so first, we're long-term growth oriented. The number one growth success of the firm has been retention, less than 1% regretted attrition a year. So it's easier to grow when you're not replacing people that are leaving. Secondly, it's individual recruiting, organic recruiting. Assets are up 50% versus recruited these in the last 9 months versus the previous 9 months. So we continue to have success in the marketplace. And when we find acquisition M&A opportunities, if they're a cultural fit, and there probably aren't a lot of firms left that we'd put in that category, we'll execute on them. So we don't force them. They happen when they happen. But we believe that we can continue to grow, attract advisors. And remember, Raymond James is primarily a financial planning firm. So 80% of our revenue directly and indirectly comes from that part of the business. So that's where we're focused on growth, as well as our capital markets businesses and others.
Okay, so open to organic M&A, but not going to force it there. You mentioned that, if you expect that markets are going to continue to grow, then your assets under advisement will continue to grow as well. I'm curious where you think that growth in markets is going to come from, because it's been really interesting watching the IPO market really kind of dry up. And we know that private markets are very hot and only getting hotter. How are you thinking about that dynamic? Companies staying public or staying private rather for longer. You have a lot of teenagers right now when it comes to the private markets.
Yeah, at some point, generally, those markets only get so big. So the private markets, you see a lot of trading amongst private equity firms, but at some point they get to a size, there's no other exit, but the public markets today. So sure, there's fewer firms going public because private's easier, less regulation, easier to grow the firm for a lot of reasons. But at some point they've got to monetize, and that's generally the public markets. So look at Facebook, how big it got before it went public. So I think that's the ultimate exit. So I think the public markets are still going to be active. So, I think there's a lot of opportunity. Right now, private equity, because of the amount of money it raised, has certainly been a bigger factor, and it's been a long period of time and has helped grow companies. But we'll have to see. Sometimes they're buying at a lot higher multiples than the public markets are buying at. But those can go up and down. We'll see where they balance out over time.
Are you concerned about this election? I mean, there are a lot of similarities in that both of these parties want to continue to spend as much money as they possibly can and blow up the deficits to unbelievable levels. However, there are differences, right? Trump wants to deport millions, stop incoming at the border, continue the tax cuts. I mean, a lot of seemingly inflationary things, and we don't know a lot about Kamala Harris's plans.
Yeah, so there are a few things we can't control. One are markets, one are regulations, and one are elections. So, we have to work with whatever the result is of all of those. So
certainly the Trump administration would reduce regulations. I mean, he wants to gut the civil service.
Well, it probably, more likely, his campaign has been more likely to do that than the other. But you have to work within the parameters, and who knows? It seems like everyone in every election that I can remember would speculate if this party got elected, it would be the destruction of, the markets, and this one would go up. They seem to not matter, in the short term anyway. Long-term policy does, and the one thing you don't hear anything is about the deficit. I mean, 3 campaigns ago, it dominated. Now no one ever mentions it, and it's,
I'm not so sure about that.
it's a bigger and bigger factor that we have to deal with at some point.
To that end, at what point does it actually matter? Because you have not seen the bond market react to it yet, not in a significant way. How do you invest in longer-term treasuries if you're really worried about the deficit?
Well, it's still a relative, the Treasury can always print, right? And it's still the currency of the world. So it's still the safe place to be, at least perceived, whether it is actually. So I think the Treasury markets are still safe. It's still in demand. The question is, how long do you go before people lose confidence and say, this isn't a good bet, it's too risky? And I don't know what that breaking point is. 10 years ago or 20 years ago, there's no way all these countries could have this much debt, but they do, and they seem to still be, working with all that debt.
Paul, you mentioned something earlier about how politics is really something that people are talking about in the course of their everyday lives, but when it comes to the market, they're more worried about the economy. How worried?
I would say concerned. You can see that the confidence has gone down slightly, but not materially. I think when they see valuations, they hear, the economy's slowing, the job growth may be slowing now, and they see the first signs, they're concerned, but not enough to panic or withdraw, right? So when the market's clearly going up and it's, going up quickly, then you don't worry about it. But I think it's a reasonable expectation to say, look, it's slowing down. What does that mean? What does that mean for my investments? But the truth is, where do you invest? So you got to put your money somewhere. And, so again, being diversified isn't so bad because you hedge your bets.
All right. Paul, great having you in the studio. Thank you so much for joining us on this new program. Paul Reilly there of Raymond James.